Good afternoon, everybody, and welcome to today's Stock Market Brief Show. We're going to give a quick insight into what happened, what took place, what's happening behind the scenes in today's market, and prep you for the next trading day. If you haven't done so already, make sure to subscribe to the channel and like and comment your thoughts there as well. We're taking a look at ES, and the title of today's episode was, Is the Market Really Setting the Stage for a Big Bull Trap? Meaning, a big bull trap means it brings up, outside of this range that we've been trading in, gets people sucked in, and then potentially reverts back in. A good example of this kind of bull trap would be IWM. Back in the day, if we bring up the weekly time frame, I can show you. We saw a nice move up, a long consolidation, a big breakout, and then it reverted back in, going into a bear market. Not to say that that's going to be the same thing here that would happen in ES, but we need to see potential price targets if we were to break out to the upside. And in order to do that, I like to look at gamma exposure levels. So this is the SPX with some gamma lines and the JPM collar. And as you can see, we've been just tightly trading within a rather condensed range over here. We're holding positive gamma. And every time we come up to the 6100, we've been rejected with some sort of catalyst or news. Over here, it was DeepSeek. Over here, it was tariffs. And over here, it happened to be the consumer sentiment. Okay, so if we start breaking through the 6100, where can we potentially go to where we can find upper resistance and potentially create a bull trap? Well, that would be that JPM collar short calls, which is going to be on for the rest of February and all the way to the end of March until they roll that trade over. And then we have 6,200, which traders are currently reaching out to. So that would be our call wall, which can act as a pin and or potentially press price away. So I think that that's what we need to be open to see. Now, tomorrow we do have PPI data coming out, so we'll talk about expectations there in a moment. Today, the SPY, right, we started the day on hotter than expected CPI data, and the market actually recovered, and it happened to be all within the daily implied move. Now, this is interesting because, well, we came in hotter than expected. So the market did not like that out of the gate, but the market then recovered. And there's something interesting from an intermarket standpoint that took place to make me say, hey, this could actually be rather bullish. So the first thing here that I wanted to point out was, well, the 10-year yield did pop up after this consolidation to the upside. And you may be thinking, is there more potential upside? Well, there very well may be. However, if we looked at those ranges, which we typically do, you can see that the 10-year yield has reached up into its upper band here, which forced many other assets to go towards the lower end of their bands. But while this is shooting up to the upside, what I find interesting is, well, oil typically leads the price of the 10-year yield, and oil today was down significantly, right? If we take a look at crude oil, and you can see crude oil was down about 2.7% on the trading session, while the rates went significantly higher. So is this just a quick is this just a quick kind of like digestion of what's going on in the markets, or is this trying to tell us something that, hey, the market, right, reacted to the hotter than expected. It came off its low, so the market looks good. Oil didn't respond in an inflationary way. It actually came off, and the 10-year yield did. So is oil in the market trying to tell us that, hey, the inflation numbers that we actually got, well, now moving forward, is the market discounting that they may potentially be coming down in the near future, right? Oil has been a good leading indicator of the 10-year yield. So, this is just day one of this, and it doesn't make a trend. But remember, oil over here found a top before the 10-year yield. It found a bottom over here before the 10-year yield. It came off at around the same time here, and as the 10-year yield's going higher, oil actually came in a bit right now. And if that is the case, well, that could be potentially positive for markets. That can potentially lead us to break out of this range to the upside until we run into some resistance up ahead. As far as current market conditions go, I look at two things. The gamma flip line, which we've been at. It's been rather neutral, so that's, check for the bulls right there. And then I like to look at the directions of the 5-day moving average amongst these various assets. And you can see SPY is right there, kind of at the lower end of its 5-day moving average. It's turning red slightly, meaning it's starting to decline. So it's really just a cautionary sign. They've been going sideways. The Qs is holding up. Biotech is still below a declining 5-day moving average. Same with DIA and same with IWM. So still at this moment, it's a coin toss right now. We need confirmation that we're going to start breaking higher, or we need confirmation that we're going to go lower, and potentially PPI might give us some of that insight that we can go and potentially tag one of these weekly implied moves. Remember, every single week this year, we've tagged the weekly implied move, and we have yet to do it So let's look at what the market's pricing in for risk going into tomorrow's trading session. So here is the SPY with the updated implied move going into tomorrow's trading session. We're looking at roughly about 599.49 to the downside, 607.23 to the upside. As you can see, that's still well within the overall implied range here. We have an anchor volume weighted average price from the February low over here, and you can see that we are currently holding that. So if we start getting below that, we may very well easily target down into this range. It'd be more beneficial to hold this as well as that week-to-date anchored volume weighted average price too. Yesterday, I talked about a Tesla trade, which I am now officially out of. But I want to show you kind of what that looked like and how it played out, right? We set it up to be a risk one to potentially earn one. And we took the trade right over here outside of the weekly implied move, and the market kind of doodled around, dropped off a little bit, not stopping me out of the position. Today, Tesla saw some relative strength. It came back into the weekly implied move and started to reclaim the week to date. And as it reclaimed the week to date and moved higher, I went ahead and placed a stop here that we talked about on the live stream today on Twitch, as well as in the Discord chat there. And I went ahead and put a 50% stop there, and then the remaining 50% stop there at break even, just to manage the current risk. When you step out and look at the daily time frame in a trade like Tesla, it's not in the greatest context, so I need to be, manage risk as I see fit. So I, managed to make 335 to 342, so $7 per share on 50% of the trade, and the remaining shares got stopped out at break even. Hope today's episode helped out, and I'll see you back on the next. Bye.